The government wants us to do certain things with our money. Okay, they are intimately interested in how we make our money, how we spend our money, and how we save our money. And they use the tax code partially to control that. This week's topic, designing a tax life like the wealthy, strategy over salary. And what we're going to talk about tonight is uh, how do the wealthy how do they do it? How do they pay 1% in taxes or less, sometimes even 0%? And how is it put together? What are the components, if you will, of designing a tax life like the wealthy? What does it mean to say strategy over salary? Those things, those topics, those things, those components we're going to talk about tonight. But let me ask you a question. You ever felt like the U.S. tax code, the tax system, even the IRS was against you? You ever thought maybe it was intentionally confusing, and they just wanted you to look at your tax bill, calculate it, pay it, and walk away? If you felt that way, you're not alone. There are, I could say, millions of taxpayers who lead their tax life kind of like that, with intrepidation, with anxiety. They're not looking forward to it. And you may have even grown up in a family like that, where tax time was about anxiety and being wrought with nerves. But the goal of these sessions is about to arm you with the knowledge and the information and the education and the exposure, so that you can design your tax life like the wealthy, with strategy and with an architect and with a design in mind, and not so much think about from a salary perspective or your earnings. So before we get started, though, I want to give you a little history, and I want to help to demystify the U.S. tax system. And the tax system that we know of today hasn't always been what it is, okay? And what I want the goal of this session to be is that I give you some information, give you some insight in how we got to where we are in our tax system and our tax code. But there's always going to be some good news in this information that I am going to give you. So hang out to the end, stay with me. I'm gonna do my best to break things down and make it understandable and digestible for you, so that you can design your tax life like the wealthy. So let's go back for a minute. Let's go back in time. It was right around 1913 that the tax code that we now know was beginning to shape up. And what happened in 1913 was the ratifying of the 16th Amendment. But before that, there was no individual taxing from the federal government. There was some from the state level, and there were some guidelines that had to be adhered to for individuals to be taxed at the state level, but there was no taxation at the federal level on an ongoing basis. But in 1913, after the ratification of the ratifying of the 16th Amendment, that amendment gave the U.S. government the power to tax other sources of income. But before the ratification, the American society received most of their income from tariffs. Okay, and I know tariffs are really, really big and upfront in the news right now. But when you think of tariffs, tariffs are another form of taxation, but they're more levied on businesses, and in particular businesses that import goods from other countries. So when you think of tariffs, or even excise taxes, which are another form of taxes, I want you to think of machinery, maybe like cars that are being imported from Japan or Germany. I want you to think of, even back then, things like liquor and tobacco and all types of goods and services that are imported from other countries. The businesses and the companies that do that importation of those foreign goods into the country have to pay a fee, which is called a tariff. So that's how, prior to the 16th Amendment, that's how money was raised for the government to fund itself. But after the 16th Amendment was passed, the government then had the power to tax the individual. And back then, the taxes were very low, from 0 to 6%. And it pretty much only really affected the wealthy. Okay. But as time went on, we had the World War One, then the Depression, then World War Two, and by 1940, the tax code started to resemble more of the tax code that we have today. So you can see how something that was started off by the politicians and our government started to expand, and over time it has expanded. But like beginning in 1940, we started having things like tax brackets. We started withholding from your paycheck for Social Security and Medicare, and then even federal and state income taxes began around that time frame in the 40s. Then we also had tax brackets that were developed as well. Okay, and as the time went on and years went on, you went from 6% all the way up to 35% in some cases over the years. Okay, the tax rates have gone up and tax rates have gone in depending on the country and its economic stability, depending on the administration that was in power at the time, depending on how the politicians wanted to influence the taxpayers. We started coming up with things like the standard deduction versus itemizations. Okay, so you can see how the system started to materialize to what we know now. We even started things like business deductions and credits. So these things were not always part of our U.S. system and our tax system. But the IRS began to grow, and it began to grow out of the necessity to collect taxes and to enforce tax law. And over time, the tax law started to grow, and the tax law started to expand. And what I want you to get out of this topic, this section, is to know that although taxes initially were put together for collection of money for the running of the government, the reality of it is that's only one aspect of taxes in the U.S. Okay, the other aspect of taxes in the U.S. was not necessarily about just collecting money, but it really was about driving taxpayer and citizens' behaviors. Okay, and I know that may sound strange, but when you think about how tax law is developed, okay, an idea in a congressman's or a senator's mind, or even a president's mind on how to affect the economy in a positive way, when you put certain laws into practice, you not only collect money, but you also incentivize the behavior of the citizens of the country. Okay, so taxation as we know it now, this is what I think is a good way of thinking about it and reframing the situation, is that, yeah, it's here to collect money. And if you want a society that is advanced and uses the collective, meaning the people and individuals that pool their money collectively, i.e. taxes, to provide, services to their citizens, that part's not a bad thing. But then you start to think about, okay, the government also put taxes and tax laws into effect to affect our behavior and drive us to do things the way they want us to do. it's a lot more intricate than that, but that's just a kind of an overview, and we'll talk about that in later sessions and lessons. I mean, that's what this is all about. Okay, so let's talk about how the tax code is built. Okay, and some intricacies of the tax code, some components, and we'll break it down on how a lot of the tax code actually works. So one of the things there's four things I want to talk about in this session about the tax code. First thing is that our tax system is progressive. Okay, and what I mean by progressive is that as your income increases, okay, as our income increases, then the tax rates that are the percentages that we pay on our taxable income increases as well. Okay, so income goes up, your tax rate goes up. Income goes up, your tax rate goes up. Okay, I had a case like that today where a client of ours, we looked at their tax situation year over year, and we were trying to make an analysis of why they were paying more taxes over the year over year. And what we found out was their raise that they received from their W-2 moved them higher into a higher bracket, okay, which I'll talk about now. There are brackets that are part of our system, and brackets came about to give taxpayers an idea of what they would pay in a certain range. Okay, and I'm gonna make it real simple. You might have a range of 50,000 to 100,000, and in that particular range or in that bracket, a taxpayer would pay a certain percentage. And when they moved out of that bracket, which is what happened to that client I was just speaking about, their percentage that they pay changed and went up. And once we did the analysis, we determined that, okay, that's what happened. And then we began to put on our tax plan and hats and said, okay, what are we going to do to mitigate the raise that was received and is going to probably continue in the next year, or in this case, this year? Our tax is self-reporting, okay? And I remember when I was first learning how to do tax preparation back in the day at H&R Block, maybe 1994, 1995. I was actually in the tax business about a year or two. And somebody said, one of my supervisors said something that was just real simple, but it just kind of opened my mind, right? What they said was, in the United States, a tax return from a taxpayer is basically their word to the government about what they earned and spent. And I had never really thought about that like that. There is no one over your shoulder. There is no, in our government, the government, the IRS does not do our taxes. In our government, the taxes aren't subtracted from our pay as we earn it. We actually get a whole year to earn money, and then we actually get the opportunity to tell the government how we spent some of that money and the deductions that we believe we are entitled to, or the expenses that we are entitled to in our business. But the fact that it's self-reporting, because in some governments in Europe and in other countries, they don't get that opportunity to self-report. They don't get the opportunity to give their word and sign on their tax return that this is my word to the best of my ability. They just get the money taken out of their pay directly. So I believe that this is a benefit to us. And I like the fact that our system is self-reporting, and you report the taxes versus the government take taxes directly out of your pay. Our taxes and our tax system is incentive based. Okay, so this is the second side of the two-sided story in our tax code. One side is for collection, and then the other side is for uh, incentives, incentive based. When from now on, if you're listening to this, I want you, when you think of or when you hear the word loophole, okay, I don't want you to think loophole in the sense that somebody's doing something underhanded or negative, okay? I don't even know how the word loophole came about. I'll probably look it up and report back to you guys. But when you hear the word loophole, I really want you to start thinking incentive, okay? And not a lot of taxpayers know this, okay? But the tax code has grown to 70,000 plus pages, okay? And it changes every year. There are new laws added, new laws subtracted, okay? The standard deduction pretty much changes every year, okay? I don't know if you guys remember, but there was a period of time, less than 10 years ago, that there were exemptions. And you got an exemption for yourself and each one of your dependents. That's an example of how the tax law changes. Um, but the 70,000 pages of tax law, most people probably think, oh, this is all about collecting money. You know, the government's gonna tax me. They're gonna raise my rates. But the reality of it is, there's more pages in the tax code in those 70,000 that are about incentivizing behavior. And if you don't like the word incentivize, maybe you should just think of it as guiding our behavior as a taxpayer. Okay, the government wants us to do certain things with our money. Okay, they are intimately interested in how we make our money, how we spend our money, and how we save our money. And they use the tax code partially to control that. I'll give you an example. Okay, I don't know how it's going to always be, but I know from the start and even today that as a rule, as an overall framework, our government doesn't want to be in the business of business, if you will. Okay, used to be this term I read a long time ago. It was in junior high, laissez faire. Okay, and what it means in short is that the government wants to back out or be out of certain parts of our citizenship, the economy. Okay, the government doesn't want to provide jobs and create businesses, because then that would be closer to other types of government like socialism. Our government wants the private sector, i.e., the citizens and the taxpayers, to create jobs and to create housing and to do research and development. So, and invest. So what they do is they promote those behaviors in the tax code. That's what I mean by incentivize. Okay. Now, when you think about it, if you've been on any of these other lessons, you know that we talked about how when you position yourself correctly, you can take advantage of the tax code in your favor. Okay, and we talked about a couple of different ways and a couple of different strategies and tactics that you can do. Okay, one of them is opening up a business. Okay, or the other one was becoming a real estate investor. So when you think about the government incentivizing the tax laws, those are the two main things that they use to incentivize our behavior. It's the government's job to incentivize us to take some money, take a risk, and buy that single family home. And they write it in the laws that if you do these type of things that help to promote the government, help to promote the citizens, help to promote a certain quality of life, we're going to write into the IRS code, into the tax laws, these benefits that you can get, like being able to write off expenses. Okay, so you can see now, I hope you see better, that the other side about incentivizing the public and the citizens and the taxpayers, and This is all throughout the code in all types of ways. Um, Real estate, business, research and development, grants, science, they're all affected by tax laws, and the government wants the people to create and to sustain and to grow the economy. Okay, so I kind of like that aspect of it. Yeah, nobody likes the collection aspect of it, but the incentivizing. Now you can see how the tax code actually, in some cases, when you position it and when you design it. Okay, and this is what the wealthy and those folks that are running their tax life day to day. This is what they understand, and if they don't currently fit in a situation where they could use the tax law to their benefit, then they design their tax life to be positioned to benefit from the tax laws. Okay, and that's what these lessons are all about. Okay, so I want to talk about some 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 key forms that are embedded in the IRS code and in the tax system that help us to align ourselves. Okay, and they're part of the fabric of our tax system. Okay, now these forms and these schedules and these worksheets, they were always not a part of the code, but over time they come and they go. All right, so the first form I want to talk about is the Form 1040. Okay. And the Form 1040, those of you guys that do your own taxes or are familiar with the tax, that is I don't know, the main form, if you will, on the tax return. 1040 is the individual tax return. Okay. And everybody that fills out their taxes in the United States uses the 1040 form. And that's what we use to let the government know what we made, what we spent, what we should get as a deduction, what we spent as deductions, and it encompasses other forms, okay, and other schedules, and it receives information from other forms, and then the 1040 form is usually ends up being a packet, okay, and you have the main form which lists the basic information like income, um, expenses, deductions, certain credits you get, the withholdings that you had, and any payments that you might receive, any credits that are paid to you or taken, and then there's the bottom line. But embedded or after those, there are other forms like your Schedule A, which deals with your itemized deductions. There's your Schedule B, which talks about certain types of interest and dividends. You got Schedule C, which lists if you're a sole proprietor, it will, or you single member LLC, it'll list your business enterprise, income expenses. Yeah, Schedule C is kind of like a IRS's version of a profit and loss statement. Okay, you're gonna have your Schedule E, which shows things like royalties. Let's say we have a few clients that are in the music business, and every year they get royalties from music that they wrote. We got a couple clients that are in the YouTube business, I guess, content creators they call them, and they receive royalties from um, YouTube and other entities. And then you also can put your rental property income, your rental investment property on Schedule E as well. But these forms are really, really important because they make up your tax return. Okay. And then finally, you got the source documents, I like to call them, and they come from without, not from without, from an outside source, um, like your employer creates a W-2 and send a copy to you, and then they send a copy to the IRS. Financial institutions create Form 1099, and from the standpoint of 1099s, I mean, off the top of my head, there are at least 7 1099s. There are probably more, but they primarily report from an outside source, financial institution, educational institution, and they report to the government monies received or and monies can come in all kind of different forms, But yeah, money's received or taxable events that happened and that need to be embedded or categorized and put on the 1040 form, okay? And then there are other payroll forms like your 940 or your 941, okay? There's estimated tax forms, 1040 ES, okay, which if you're a business and you want to pay your quarterly taxes on your own on your estimated income, those are forms that you create, so you become the source based on your income and expenses. And then there are the actual forms that the businesses fill out, okay? 1120S form, that's a corporation return. So that would be a return that a IBM or Apple or a Cisco would fill out and submit. And again, think about this. This is their word. The company's giving their word. The government's not sitting there siphoning off money as the company earns income. There are the 1120S, which is a smaller version of a corporation, and it's usually typically for maybe a single member LLC that has transitioned and increased in income, or you might have a partnership, and that's on a form 1065. But the idea of knowing these forms, knowing about the forms, knowing what they do, knowing how they affect your tax return, and how these forms actually help to guide you, that's important. Okay. It's I mean, again, I'm not ever saying you need to go and get a degree in taxation, but the idea of knowing these forms and getting familiar with them. Okay, and we'll talk about that a little later. All right. But how much you understand and how you understand the game and how you understand it's structured and how the system is put together will help you to put the design together and position yourself like the wealthy and do strategic thinking versus just earn the money and blindly go pay the taxes that the form says to pay or your tax preparer says to pay. Okay. So next, I want to talk about something that I've always thought about, in particular when I started to move into tax planning. Okay. When I realized that tax planning was a more holistic way of doing things versus tax preparation. Okay. In my, let's say, in my maturation as a tax professional, and I started to think about different categories of taxpayers, if you will. So I thought of this idea, and I call it the taxpayer ladder. Okay. So I want you to, I think at some point in time, I'm going to be able to provide illustrations and things like that. But right now, just in your mind, think of a ladder. Okay. Don't even think of the big, long 6-foot ladders. Think of the little short ladders, maybe step ladders they used to call them. Might have maybe 2, 3, 4 rungs on it, right? So what I call this taxpayer ladder is, in my mind, it's where a taxpayer may fall in their knowledge of our tax system. Okay, and I wrote down what the each rung on the ladder means to me. All right, and so let's see, you got 4 rungs. The first rung being the lowest rung. Okay, well, like this, and I call that the W-2 earner, the bottom rung. Okay, and there are some points about the W-2 rung that are really important to understand. Okay, so primarily the W-2 rung are those taxpayers that have one stream of income. They may have multiple W-2s, but you don't have a business set up. You don't, receive investments. You don't do a lot of investing. You don't receive a lot of interest, but primarily W-2 and very few deductions. Okay. So as I stated in the previous lessons, A W-2 earner doesn't have a whole lot of incentive. Okay. And I don't know if that's by design, but I believe the government just thought, well, if they don't have a business, then why should we really incentivize somebody that just goes to work? I mean, that's pretty much as plain as it could be. There, there's no real extraordinary or additional risk from going and being an employee. But I can tell you personally that there's a plenty of risk in trying to start a business and operating a business and growing a business. So in my mind, as a business owner who used to be a W-2 earner, I can understand the incentivizing of the business owner. Okay. And the loopholes, which are really just tax laws to the advantage of the business owner, I can understand that, and it makes sense to me. Okay. And we will get into that in another lesson, but this is the W-2 rung. Okay. And overpaying in the taxes is common. Okay. Overpaying in your taxes is common. And one of the reasons why you overpay is because you don't have those built-in incentives. The next rung, this is one, this is two. I call this the side hustler, the 1099 worker. All right. And this rung of the ladder has increased exponentially, especially since COVID-19 and the pandemic. And, there's always been people that go to work and then have a side gig. Okay. I don't know about any of you guys, but, coming up, we always had the guy that was, did some plumbing on the side, right? He might work as a plumber for somebody, and then, on the weekends, he does plumbing on the side. Okay. Or, somebody that fixes cars on the side, right? And it's more official nowadays, okay? There's consultants, IT consultants and cybersecurity and wedding consultants and travel consultants, and they all set up LLCs. Well, they should all set up LLCs and make it real official. Some don't, but they should. But this is where small business activity starts to begin. This is where the incentivizing begins. And you can start taking deductions on your business expenses, okay? And then you start to, even some gig workers, side hustlers, start to pay estimated taxes because they don't want to owe at the end of the year on their profit, okay? So that's the second rung. And you can see how you start to design, if you will, your tax life when you move to that second rung. Okay, this is the tax ladder again, okay? Taxpayer ladder. The third rung, okay, 1, 2, 3, okay. I call that the business owner and investor, okay? And this is where a whole world opens up to the taxpayer in the behavior modification, if you will, or in incentivizing, okay? You get access to major strategic tax tools like depreciation, which you talked about in a previous lesson, deferral of income, okay? There is entity structure, okay? Maybe going from single member LLC to that S corporation we talked about earlier, okay? All this is now opened up to you, and you now have these tools which you can now use to design, like the wealthy. You see where we're going from salary to strategy now, okay, on that rung 3. And then you can begin to position yourself to take advantage of more of the incentive, i.e. tax laws that benefit business owners and investors, okay? And when I say investors, I'm also talking about real estate investors and investors in business. You might be a stock investor, okay? And then the 1, 2, 3, the fourth rung, of the ladder, the taxpayer ladder, I call the um, tax life strategist. Tax life strategist. Okay, and the tax life strategist is dialed in. Okay, and you can become a tax life strategist. Just keep watching and telling folks about us, and you will be surprised on what you will know going forward, let's say a year from now. But tax life strategists is kind of dialed in, okay? They've gone from probably mostly being a W-2 earner, they moved into the gig work, okay? They may have decided, like me, one day to say, you know what, I want to try to control my own destiny a little bit. Um, I want to be an entrepreneur. I want to start my own business. I want to grow a business. I want to um, make a business, big business, right? Um, and so that tax life strategists, they've gone through the stepping of those rungs on the ladder, and now they're at the top ladder on that step ladder, and the income now that they receive flows from designed channels. Okay, so when we talk about the income coming from design channels, right? Years and years ago, I read this book called Multiple Streams of Income, right? And this was when I was just beginning my entrepreneurial journey. And the book described how in business, the author, I forget his name, I'll bring the book and I'll show it to you. But the author, his his thesis was if you're in business to have multiple streams of income, okay, is better than having just one. It's the old thing about having all your eggs in one basket. But he also talked about the multiple streams should all come from one channel, okay. And it's like maybe an arm, and then the arm is the channel, and then the streams are the fingers, right? And this is what happens when you become a tax life strategist. You've into that business aspect, and a business is just like a life. A business is born when it started. A business is nurtured by, um, you know, income and cash flow. Business grows, maybe go from one location to two locations, or from one employee to two employees. And then in a lot of cases, a business dies. Okay. And so the idea of multiple streams of income, when I think about that, that's where the design comes in. Okay. You have to actually design those different streams. It just doesn't happen by default, like just doing a tax return, taking it in there to H&R Block and getting it done by a tax preparer. Okay. The tax life strategist has year-round planning. Okay. I sat with a couple today, um, and when I explained to them the difference between tax preparation and tax planning, and I said I'm involved intimately in both, but I was trained primarily initially in tax preparation. We only knew about that aspect, and for years that's all I did until I was exposed to tax planning. And tax planning is year round. Tax planning, in my opinion, is daily. And I explained to that couple today that taxes in some shape, form, or fashion are all around us. Sales tax, excise taxes, um, tariffs, if you will, school taxes, real estate taxes, um, income taxes, federal, state, local governments have taxes. So yeah, in my mind, it's not a far-fetched thing. It's not a stretch to be living a tax life where whenever you make a purchase, whenever you go somewhere, whenever you're spending money, whenever you're thinking about saving money, whenever you're planning for the future, that your tax life becomes thought a part of that process. And when I kind of explained it to them, they were like, "Wow, Jeffrey." And I still get excited about that because it was just 5 years ago that I started thinking like this and designing this aspect in my business as an additional income stream. Okay, so when you're a tax life strategist, you you got the year-round planning, you got designing of how your income streams come, your channels, and then a lot of times you put together a team, okay, in your tax life, and your team might consist of it might consist of your preparer, it might consist of here, let me go. It might consist of your preparer, it might consist of your financial advisor. Let me see this thing. Two, it might consist of estate planner. Three, your lawyer, your CPA. So you understand what I'm saying, okay? It You put a team together and you start to become that designer. And you don't have to be wealthy to do some of the things that the wealthy do. Okay. But you're moving from salary to strategy. Okay. And you put systems in place and you increase your knowledge. Okay. Now, for this session's immutable law or principle, okay, called the law of exposure. And I like to read these because I really want to be emphatic about these principles and laws. And I really want to always restate that these laws cut across all areas of your life, not just your tax life. But today's, this session's principle, you can't engage with what you've never been exposed to. You can't engage in what you've never been exposed to. And I want to qualify a little bit and say, I want to say that you can't engage fully to that you've never been exposed to. And I want that to sink in for a minute, okay? And I want you to think back to something that you know now that uh, you do without even thinking, okay? And it's not something that was an automatic response like, I don't know, blinking, but something that you learned, okay? It could be a discipline that you use at work. It could be a discipline that you use as a parent. It could be a discipline that you used physically, but you didn't know it, and you couldn't be fully engaged in it. I don't know. Let's just say chess. I like chess. I like to use chess. But I mean, I'm sure all of us have seen some kind of TV show or something, or been exposed to chess. But until you actually get involved in it and increase your exposure, then you can never really fully either appreciate or take action in or participate in until you're fully exposed to it. And the more and more you're exposed to it, like chess or even playing an instrument, it takes practice. But the more exposure to it, like the tax code we just talked about, and the more you know about it, the more you can fully engage with it. Okay. Exposure changes everything. Once you're exposed to the system and how it truly works, you have the ability to fully engage, and you should never go back. You probably can't go back to where you were before you were exposed to it. Okay. Um, so when you're fully exposed to things, though, and in this particular case, I want to bring it back to the tax code. That's what these lessons are about. They're about exposure. They're about bringing attention to them. But once the attention is brought and you're exposed to it and you're open to learning more, then you start to ask better questions. Okay, well, what about this? What about that? Okay, how does this work? What's my incentive in this? Do I have an incentive? Okay, how do I position myself? And then when you start to ask better questions, you start to demand better answers. Okay, let me give you some final thoughts. Okay, um, as you guys may have heard, back in the day, much younger, when I was coming up, wanted to be a pro football player. That was the first goal, and then the next thing was to take all the money that I was making, because I knew pro football players was rich, right? Not as much as they're rich now, but The idea was to take that money and start businesses. Okay. If you guys want to think about what I was thinking about in my mind, which I didn't really realize, but the folks that are doing it now, you're looking at how Magic Johnson has taken not all the money, but his money that he made from basketball and endorsements and all that, and now he's more valuable financially as a businessman than he ever was as a pro basketball player. The same with Shaquille O'Neal. It's obviously the same with Michael Jordan. Same with Steph Curry. I just saw a program that's going to come on CNBC about Steph Curry, the business. But my thought process is saying that it's really about knowing the game, okay, and knowing what you want to do and being exposed to it, okay. And in my mind back then, as a child, I believed that that first career was going to help me design the second career, okay. And I obviously didn't know all the things that I know now, but I guess I was blessed with a dream, and that dream, it kept me out of trouble. It got me to college. It helped me get to where I am right now and where I'm gonna go. So when you know the game, you can change the game. Is what I'm trying to say. All right, and a couple of things I wrote down. Our tax system isn't just about tax collections and bills. It's a blueprint to build your tax life. Okay, and what the government wants us to do, it tells us to do this through tax law and incentivizing us through tax code, is they want us to start a business. They want us to save for retirement. Okay, they want us to buy real estate. They want us to invest in the market, and they want us to invest in education. And there are tax laws and incentives for all those things I just mentioned. Those 1, 2, 3, 4, 5 things that I mentioned. Okay, so there's no doubt that there's incentives in the tax code to drive our behaviors. The question is, what are you going to do about it? Okay, if you're watching this at any point in time, now you know. Okay, and when you know better, there's a tax maven that I like, Carla Dennis. She says, when you know better, you do better. Okay, so my job is just to bring this to your attention and expose you to it, and then expose you to as much tax knowledge as I can, so that you can make the move and make the leap from not knowing the game to knowing the game and how it's played, or at least being in touch with somebody who can guide you on how the game is played. Okay, so really want to recap really quickly. All right, so the tax system we talked about is progressive. Okay, it's brackets, it's incentive based. Okay, that's the main thing I really want. That's one of the main things. The incentives. It's the incentives. The incentives gives us the ability to design. Okay, and it rewards our behavior if we follow the incentives. Okay, businesses and investors are taxed differently. I want you to remember that. Okay, they're taxed better. And okay, it's not the taxation that's better in the sense that rates are better in some cases, but in some cases rates are better. Capital gains rates, which are invested money, are lower than income tax rates, which is money that is made as a W-2 or income. So that's one example of them being taxed better. But they're also, business owners and investors are also incentivized. Okay, strategy isn't about loopholes. Okay, let's get rid of that thinking. Strategy is about taking advantage of incentives and designing it where you are right now to put you to where you want to be. Okay, and then finally, what you are exposed to will help you to play the game. Okay, and being exposed through these sessions and other means are going to give you the means to take care and move your tax life into the position that you want it to be in to achieve your goals. So that's it for this session. I appreciate those that are tuning in on a regular basis. I really do. This is my passion. I'm moving forward with this as long as I can. I'm transitioning. My business is transitioning. We are full-fledged, 100% on board with making the transition over time to a full-fledged planning and advisory firm. Okay, I love my tax preparation clients, and I appreciate them. And when they're ready and exposed to enough, they'll be moving into that tax planning arena. But there are tax planning clients that I do have that I appreciate, and we are moving in that direction further. Okay, but really, just thanks a lot. Appreciate it. Tell somebody about these sessions, the YouTube page. I'm moving closer and closer to that start date. And as always, I want you to ask yourself, and I want to ask you, what's your dream?